guys, it's Stock Curry, and brace yourself because this could be the worst week in the stock market in years. In today's video, I will explain why, and I'll also tell you what you can do to profit from it. So let's get into it! Last week, the Dow fell 4.6%, the S&P 500 fell 5.1%, and the Nasdaq lost 5.6%. That was one of the biggest declines since January. And this week could be worse. As of the recording of this video, the Dow futures are down 1%, Nasdaq futures are down 2%, and the 10-year Treasury is up 1% to 3.195. A lot of this fear is being driven by the fact that the Fed meeting is happening this week. On Tuesday and Wednesday, the Fed will meet for their next interest rate hike, and on Wednesday, we will find out how much the Fed is raising interest rates, and we'll also get our speech from Jerome Powell. Now, going into last week, pretty much everybody expected the Fed to raise interest rates by 0.5 percentage point or 50 basis points. However, after last week's CPI or Consumer Price Index numbers, there is now priced in a 26% chance of a 75 basis point hike or 0.75% rate hike. If we get that, that would double the current interest rate. The reason people are fearful the Fed might actually raise interest rates higher than they said they would is because the CPI numbers or Consumer Price Index numbers for May came in much higher than expected, significantly higher. Let me dig into the numbers right now to show you just how bad it is. The blue line here shows the total CPI or Consumer Price Index. It was expected to drop in May, but it didn't. It actually rose to the highest level in 42 years, all the way up to 8.6%. Now, what's interesting is the red line here. This is called core CPI, and this is CPI minus food and energy. It did have its second drop in a row. So what's happening right now? Why is total CPI rising while core CPI is dropping? And what's the difference? Well, if we take a look at this chart here that breaks it down, you can see how food is up 10% year over year, while energy is up 34.6% year over year. Meanwhile, the core CPI, that is all items less food and energy, is up 6% year over year. Now, the reason the Fed breaks it down like this is because they can't control food and energy. The Fed can only control what's called core CPI. That is everything other than food and energy. When the Fed raises interest rates, it causes people to spend less money on things that they, well, we'll say don't necessarily need. So it can cause housing prices to come down a little bit. It can cause rental rates to come down a little bit, maybe. It can also cause a lot of other things to come down. Now, the problem is the things that people really, really need, food and energy, gas in their car to get to work and back, and the food to put on their table, those things, and I get it, you really need a place to live too, but at least the Fed has some control over that. But the food and energy, the Fed has no control over. And these are the two things that people really need to live. You can't live without them. Look, I was homeless. You can live without shelter, trust me. But you cannot live without food and energy. So the problem is those are the two things the Fed cannot control. Those are the two things that are affected by global factors such as wars and OPEC and supply chain shortages and things that you just literally are completely out of the control of the Fed. Now, the major problem is this. Clearly, core CPI is coming down. That shows that the Fed raising interest rates, it's working and they are getting core CPI down. However, the fact that food and energy continue to rise means that where people actually spend their money, that is going up. And as the place where people really spend their money continues to rise, it puts more and more pressure on the consumer. Now, even if the Fed can get the core CPI down, in order to do that, they have to trigger a recession. But if they trigger a recession to get core CPI down, but food and energy continue to rise and continue to inflate, then we enter into a period called stagflation. That's where we're in a recession because the Fed has raised interest rates in order to get core CPI down, but inflation from food and energy continue to rise. So we have inflation and a recession at the same time. It is literally the worst possible scenario for any government, because the high inflation hurts GDP, pushing it down lower. Meanwhile, they have to raise interest rates to stop inflation, and that also pushes GDP down lower. But they can't get out of it because inflation is really caused by external factors beyond the country's control. So it's just a terrible, terrible situation. We went through this during the 1970s, and we ended 3 recessions in 10 years. The stock market fell 80%. It is a terrible, terrible situation for any U.S. economy, and right now, that's where we're at. Now, I want to dig deeper into these CPI numbers because it's going to help paint the picture a little bit better. Energy overall was up 3.9%. But fuel oil was up 16.9%. By the way, this is month over month. Gasoline month over month up 4.1%. Other motor fuels up 7.6%. Gas from utility lines up 8% month over month. Of course, all of this is really hurting consumers. So if people are spending more on food and gas, they have to be spending less elsewhere, right? Well, absolutely. Take a look at this. Window coverings down 2% month over month. Bedroom furniture down 1.6%. Major appliances down 2%. Clocks, lamps, decorated items down 3.7%. Televisions down 3%. Computers, peripherals, smart home assistants down 1.4%. Telephone hardware, calculators, other consumer items down 3.2%. Smartphones down 5%. So this is showing a clear shift away from things that people don't really need and more towards items that people have to spend money on. What it means is that consumers' pocketbooks are getting tightened and they're simply running out of cash to be able to go buy the things that are extras in their life. Now, this is a really big major problem because right now consumers are struggling, but they're making it. I mean, barely. They're living paycheck to paycheck, but they're making it. As inflation continues to rise, especially in food and energy, it's going to get to the point where consumers can no longer afford even basic necessities. And when we get to that point, that is when a major recession is going to start because people are going to start having to not pay certain bills. Maybe they miss a few credit card payments, or they miss a few mortgage payments, or they miss the rent. And this is where major, major problems in the economy start. We are already starting to get there, and the CPI numbers that came out on Friday are a very clear indicator of that. There was another thing I talked about last week. I said once oil prices got above $5 a gallon, that is when a recession gets triggered. And sure enough, gasoline prices are now above $5 a gallon, and they're likely to head even higher. So all signs are there. Everything is now in place for a major recession. As inflation continues to rise, people are already starting to spend less on things that they don't need. That's the first trigger of a recession. Gasoline prices are above $5 a gallon. They're continuing to rise. That's another trigger of a recession. We're already seeing housing prices starting to drop. That's another trigger of a recession. And globally, the global economy is slowing down, and that is going to trigger a worldwide recession like we saw in 2008, only this time it's going to be far worse than 2008. It's going to be far more similar to the 1970s because of the high energy prices. This recession is going to be the worst that we've seen in 50 years. So brace yourself. With the Fed meeting on Tuesday and Wednesday, the stock market is about to absolutely crash this week out of fears about how much the Fed is going to have to raise interest rates even more in order to get inflation under control. So how can we profit from this? Well, the real time to enter into any sort of trades would have been Friday. And if you follow me in the VIP Discord, we did enter some put options on the market on Friday. Those are going to pay off beautifully this week. By the way, if you want to know everything that I buy and sell, I post all of my trades in the VIP Discord. If you want access to that, you can sign up at stockcurry.vip/getvip. That's stockcurry.vip/getvip. Last week we did a straddle in anticipation of the CPI numbers coming out. That paid off beautifully. There were a lot of people that made a lot of money on that trade. Now, I only made a 31% profit on that trade because I messed up the trade a little bit, but other people in the Discord that executed a little bit better, they were up 50 to 100%. And this week, I think these put options are going to pay off even more than that. We should see massive profits in our put options this week. I'm estimating about a 300% profit, but I'll let you know what it is once it actually closes. Again, if you want to know everything I buy and sell, just follow along in the VIP Discord. You can get that at stockcurry.vip/getvip. So what if you did not open put options last week? What can you do? Well, I don't think it's too late to open put options. I think the market is going to continue to fall on Monday, Tuesday, and Wednesday in anticipation of the Fed raising interest rates higher than expected. So if you are a risk taker, and I want to warn you, what I'm about to tell you is extremely, extremely risky. But what you could do is you could open up some put options for the market on either SPY or QQQ that expire on Wednesday and take advantage of the Fed meeting. Now, if you do that, personally, if I were to do that, I would sell them before Jerome Powell speaks, before we know what the Fed is going to do, because there's a good chance that once Jerome Powell speaks, he's going to calm the markets a little bit and help bring the stock market back up. I've seen this happen time and time again where all of the information was bad, the markets drop significantly, and then when Jerome Powell starts to speak, he kind of soothes over the markets a little bit and brings up hope for people, and then the stock market starts to rise significantly as he gets into his Q&A. So if you do any sort of put options, like personally, I would sell them before Jerome Powell speaks. But again, you know, this is not financial advice. This is not a recommendation to go buy, sell, or hold anything. These are just my own personal opinions, and I could be dead wrong. So just keep that in mind. Alright guys, I hope you enjoyed this video and got a lot out of it. Don't forget to hit the like button and subscribe. And if you are on YouTube, go ahead and click the bell icon and click all so that you can get notified when I release my next videos. I hope you have a lot of success trading, and I will see you tomorrow.